Did you know that up to 85% of your Social Security benefit could be taxed and the IRS doesn't send you a warning before it happens? Most people collecting Social Security right now have no idea they've already crossed the line, and the ones who find out usually find out the hard way when a tax bill shows up that they weren't expecting, or when their refund is suddenly hundreds of dollars smaller than last year. Here's what makes this especially frustrating. The rule isn't based on how much Social Security you receive. It's based on something called your combined income, and that calculation includes money sources that most people never think of as taxable. In fact, even income that you already paid taxes on could push you over the limit. Stay with me for the next 10 minutes, because by the end of this video, you're going to know exactly how this rule works, how to figure out if it applies to you, and what you can do right now to protect more of your money. This is one of those topics that sounds complicated on the surface, but actually becomes very clear once someone walks you through it step by step. That's exactly what we're going to do today. We're going to cover 3 things. First, what the 85% rule actually means because it's widely misunderstood. Second, how the IRS calculates whether your benefits are taxable, using something called the combined income formula. And third, what actions you can take today to reduce the tax hit or at least stop being caught off guard by it. No jargon, no complicated math, just a clear explanation that finally makes this make sense. Let's start at the very beginning. First, let's clear up the biggest misconception right away. The 85% rule does not mean the IRS takes 85% of your Social Security away. It means that up to 85% of your benefit can be counted as taxable income. So if you receive $20,000 a year in Social Security, up to $17,000 of that could be added to your taxable income for the year and then taxed at your normal income tax rate. There are actually 3 tiers to this rule, not just one. If your combined income is low enough, none of your Social Security is taxable. 0, the IRS doesn't touch it. If your combined income falls into the middle range, up to 50% of your Social Security may be counted as taxable income. And if your combined income exceeds the upper threshold, up to 85% of your Social Security is taxable. So the real question is, what is combined income and are you over the limit right now? That's what most people don't know, and that's what we're going to fix right now. The IRS uses a specific formula to determine whether your Social Security is taxable. They call it combined income, and it has 3 parts. Part 1 is your adjusted gross income. This is essentially your total income before standard deductions, things like wages if you're still working, pension income, withdrawals from a traditional IRA or 401,000, rental income, dividends, and capital gains. Part 2 is any tax-exempt interest you earned. This surprises a lot of people. If you have money in municipal bonds or a municipal bond fund, the interest is normally tax-free at the federal level, but the IRS still counts it in this formula. That feels unfair to many people, and honestly, they're not wrong to feel that way, but it is the rule. Part 3 is half of your Social Security benefit for the year. You add all 3 of those together, and that total is your combined income. Now here are the thresholds you need to know. If you file as a single individual and your combined income is below $25,000, none of your Social Security is taxable, between $25,000 and $34,000, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. If you're married filing jointly, the numbers shift slightly. Below $32,000, no tax on benefits. Between $32,000 and $44,000, up to 50% may be taxable. Above $44,000, up to 85% may be taxable. Here's the thing that catches people off guard. These thresholds were set back in the 1980s and early 1990s. They have never been adjusted for inflation. So as Social Security benefits have grown over the decades, and as more retirees have additional income sources, more and more people are crossing these lines every year without making any changes to their lifestyle at all. If you found that helpful, go ahead and hit the like button. It helps more people find this information when they need it. Let's make this real. Let's say Margaret is 68 years old, retired, and filing her taxes as a single person. She collects $18,000 a year in Social Security. She also pulls $15,000 a year from her traditional IRA to cover living expenses, and she has a small amount of interest from a municipal bond fund. About $1,200 a year. Her combined income calculation looks like this. Adjusted gross income from the IRA withdrawal is $15,000. Tax-exempt interest is $1,200 and half of her Social Security, so half of $18,000 is $9,000. Add those together, $15,000 plus $1,200 plus $9,000 equals $25,200. Margaret is just over the $25,000 threshold. That means up to 50% of her Social Security, up to $9,000, could now be included in her taxable income. She didn't get a raise, she didn't do anything differently. She simply crossed a line that hasn't moved in decades. Now imagine if Margaret was also receiving a small pension of $6,000 a year on top of that. Her combined income jumps to over $31,000 and she's deeper into the 50% zone, possibly approaching the 85% zone depending on exact figures. This is why so many retirees get a tax surprise. The math quietly sneaks up on you. Here's the important question: who is most likely to be hit by this rule? If you have a pension from a former employer, you're at higher risk because that pension income directly raises your combined income figure. If you're taking withdrawals from a traditional IRA or 401,000, not a Roth, those withdrawals count too. If you're still working part-time, even modest wages can push you over. And if you're receiving interest, dividends, or capital gains from investments, all of that adds up in the formula. The people least likely to be affected are those whose only income is Social Security itself, with very little or nothing else coming in. But the moment a second income source enters the picture, the math changes fast. We'd love to hear from you right now. Drop a comment below and tell us, did you know your Social Security could be taxed before watching this video? Just say yes or no, it helps us understand what information people need most, and your comment might help someone else who's wondering the same thing. Now here's the part that actually matters. What can you do? First, calculate your combined income right now. You don't need a tax professional to do the basic math. Take your adjusted gross income, add any tax-exempt interest, add half your annual Social Security benefit. That number tells you where you stand. If you're already above the thresholds we mentioned, you need to know that before tax season, not after. Second, consider adjusting your tax withholding. You can actually request that federal taxes be withheld directly from your Social Security check. The form is called a W4V, which stands for Voluntary Withholding Request. You can choose to have 7%, 10%, 12%, or 22% withheld. This won't reduce your tax bill, but it will prevent a surprise at filing time. No one wants to owe the IRS a lump sum in April. Third, think about the timing and source of your withdrawals. This is more of a long-term strategy, but it's worth knowing. Withdrawals from a Roth IRA are generally not included in the combined income calculation. So if you have both a traditional IRA and a Roth IRA, there may be a tax advantage to pulling from the Roth first. Talk with a financial advisor or tax professional about whether a Roth conversion makes sense for your situation, but know that this strategy exists. Fourth, if you're not yet 73, be aware of required minimum distributions. Once you hit 73, the IRS requires you to start withdrawing from traditional retirement accounts whether you want to or not. Those mandatory withdrawals count toward your combined income and can unexpectedly push you into a higher tax zone on your Social Security. Planning ahead forums is one of the most underutilized strategies in retirement income management. And fifth, don't ignore state taxes. Everything we've covered today is about federal taxation, but about half of US states also tax Social Security to varying degrees. Each state has its own rules, thresholds, and exemptions. Depending on where you live, your state tax bill could add another layer on top of what you owe federally. It's worth a quick search or a call to your state's tax authority to understand what applies to you. Let's bring it all together. The 85% Social Security tax rule means that up to 85% of your benefit can be counted as taxable income. It does not mean the government takes 85% of your check. Whether you're affected depends entirely on your combined income, which is your adjusted gross income plus tax-exempt interest, plus half of your Social Security benefit. The thresholds haven't changed since the 1980s, which means more and more retirees are crossing them every year simply due to the growth of benefits and additional income sources. The most important thing you can do right now is calculate your own combined income and find out where you stand. If you're already over the threshold, request a W4V to start withholding taxes voluntarily so you're never caught off guard. And if you want to plan ahead, talk to a tax advisor about Roth strategies and how to manage your RUMs when they start. Knowledge is protection when it comes to retirement income. The people who get hurt by this rule aren't the ones who earn too much, they're the ones who simply didn't know it existed. If someone you care about is collecting Social Security right now, please share this video with them. It could save them from an unexpected tax bill that ruins their spring. And if you want to see more videos like this breaking down the rules that affect your retirement in plain, clear language, subscribe and hit the notification bell so you never miss one. You worked hard for that Social Security benefit. You deserve to understand exactly how it works.